Good morning. It's Tuesday, the 1st of October, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. Well, it's the 1st of October. Just to say that again, time does fly, does it not? A colleague actually told me yesterday that he can already see 2024 ending now. And yes, that does make me feel that time does fly fast. Of course, before we think of that, we have to think of Mumbai's second summer, which is starting now on the back of India's monsoon rainfall this year, which was at its highest since 2020. And rainfall over the country from June through September was 107.6% of its long period average, and that being the highest in the last 4 years, according to the Indian Meteorological Department. And that brings us to the take, the China syndrome. In July, India's trade minister, in a virtual interaction with Indian diaspora in the United States, said that a China plus one and an anywhere but China thinking in the developed world is encouraging people to look at India apart from our own efforts, that's India's efforts to attract manufacturers to the country. This was reported in the Economic Times. Last week, he told the Times of India that India's manufacturing prowess is driven by its own competitive advantages and not by reliance on any China plus one strategy. He was speaking in the context of a decade of India's own Make in India efforts. At that time, he said there was no China plus one or no anti-China mood. We've been successful in all of this despite 2 wars, 2 years lost in COVID, and we've achieved all of the above, the minister said. Well, there is a shift in stance quite evidently, at least to me. Now, the minister, however, was only reflecting what industry has been saying for some time now, that the country's China plus one strategy of attracting global companies to move supply chains to India has not really worked, at least to the extent we thought it would or hoped. And to be fair, this is not for lack of trying. But even as we've done so, the pendulum has only swung further away. A report by the Delhi-based Global Trade Research Institute a few months ago pointed out that imports from China have been consistently rising from $70 billion in 2018-19 or 5 years ago to about $101 billion last year. India's total imports last year were around $677 billion, of which around that $101 billion came from China, or about 15%. India's own exports to China, in case you were interested, were holding or have been holding around $16 billion, but for the last 5 years. But the numbers get a little starker as you dive in. In sectors like electronics, telecom, and electrical products, some 38% of India's imports came from China. In machinery, 40% came from China. In chemicals and pharmaceuticals, about 29%. So, despite India's myriad efforts to boost manufacturing, including production-linked incentives and other subsidies, China's stake in the country's product economy, that's in India's product economy, is obviously increasing. On the other hand, for the last few years, China's economy has been under pressure, including thanks to slowing demand. And there have been, of course, significant geopolitical shifts, thanks also to countries like the United States stepping up tariffs against China and encouraging multinationals to develop alternative sourcing strategies. Now, all of this gave hope to other countries, including India, that this could lead to manufacturing moving out of China, as the trade minister's July statement suggested. But now it looks like China might be back in the game. On Monday, Chinese stocks swept to their biggest single-day gains in 16 years. The CSI 300 blue chip index is now up nearly 30% from its February lows, which by some market definitions suggests that it's in a bull market. This blistering rally in Chinese stocks has come on the back of last week's most aggressive stimulus measures announced by Beijing since the pandemic, ranging from outsized rate cuts to fiscal support in an attempt to shore up an ailing economy, according to Reuters. Moreover, the People's Bank of China also introduced 2 fresh tools to shore up the stock markets, pushing up stocks which had been stagnant for several years. It's really a big turnaround. The policies are so intensive. We've never seen such clear instructions to stop housing prices declining and support the stock market, an analyst told Reuters. Now, there is obviously some understanding already in India that while manufacturing will grow in India, for various reasons, the China factor seems to be receding. Now, pumping up India's manufacturing is not an easy task, regardless of which government claims what, because the problems plaguing manufacturing investment and expansion have been around for long and range from high costs, including land, labor, and capital, to weak infrastructure and, of course, cumbersome laws. Now, there are several manufacturing successes in India, domestic and export-oriented, but it's not clearly enough, including to absorb more surplus labor. The one factor where India could focus on is to make it cheaper and more competitive to build locally rather than by erecting tariff walls as we've done in the last decades. 10 years ago, average tariffs were 13% and perhaps heading down, and today they are at 18%, amongst the highest in the world and double of countries like China and Vietnam. Reducing tariffs since exports also contain imported raw material, is perhaps the only approach left in some ways to overall manufacturing growth, but one that we need to revisit or visit with some urgency. And that brings us to the top stories and themes for the day. The stock markets fall sharply as corrections set in. Oil prices unstirred by Middle East tensions so far. A lifting of ban on India's rice exports is bringing down global rice prices and cheer to non-resident Indians. Mumbai logs the fastest 100,000 property registration mark, and 140 years of coal power in the United Kingdom is ending.
This is the Core Report with Govindraj Ethiraj.
The markets go into correction mode. The markets seem to be looking more stable going into this week, but that was not to be. The international cues were fine, but the China factor, which we just spoke of, is now causing global investors to re-examine their allocations and priorities. The 30-shared Sensex fell about 1,272 points to close at 84,299, while the broader Nifty 50 was down about 368 points at 25,810 on Monday. The Business Standard said about 41 of 50 constituent stocks of the Nifty 50 were in the red, pulled down by Hero MotoCorp, Reliance Industries, Axis Bank and Bharat Electronics, which fell up to 4%. Interestingly, the metal stocks JSW Steel, Hindalco and Tata Steel did well. Remember, China demand is expected to go up. In China, the CSI 300 index jumped as much as 9%, the most since 2008. Analysts told Reuters that foreign investors are afraid of missing out. Hong Kong's Hang Seng index, which rose about 2.4% on Monday, is now up roughly 24% for the year, pushing aside Taiwan to become Asia's best performing stock market. Stocks of property companies so far languishing also jumped in China, with mainland-listed property stocks advancing about 8%, said Reuters, adding that the Hang Seng Index had the best month since November 2022, with a 17% rise after delivering its biggest weekly rise since 1998 last week, and the fifth largest in the last half century or 50 years. And meanwhile, China's mainland financial markets will be closed on October, or rather from October 1st, that's today, to 7th for National Day holidays. AI fever is receding. Well, China is gaining, as we said, but AI or artificial intelligence fever is receding. Gone is the first half of 2024, where investors' passion for AI stocks drove the markets skyward, the Wall Street Journal said, adding that the third quarter has brought a new order to markets. Investors were also recognizing that they had got too reliant on a few big tech stocks. And now broad swaths of the market, from utilities to industrials to financials, trounced the powerful technology sector. Value stocks have beaten growth stocks. Small cap stocks have emerged from their torpor to leave the large cap peers in the dust, said the Wall Street Journal. And lessons for India? Well, not so much. Indian markets have been rising more steadily across industries and sectors, and if anything, have been driven by small and mid-cap differentiation, so the size of the stock rather than the sector location. Oil prices hold out against tensions. Oil prices have not reacted so much to the Hezbollah confirming its leader was killed on Friday in an Israeli airstrike in the Lebanese capital of Beirut. The incident follows several months of conflict and had raised concerns of a wider conflict involving Iran. Oil markets did not see a surge as such. Global benchmark Brent crude oil prices added only marginally to about $73 a barrel, while US West Texas Intermediate futures were again only marginally higher at about $68 per barrel. CNBC reported that while hostilities throughout the Middle East have ramped up, there have not been any oil supply disruption. One analyst told CNBC that the oil market is not expecting an all-out war between Iran and Israel that would impact supply. On the other hand, the oil market is reckoning with increased production from the United States, Canada, and Guyana on top of stalling Chinese demand. And whether, of course, that stalling Chinese demand will remain so is something that we have to see. Experts did tell CNBC that a rapid escalation in conflict, including a closure of the Straits of Hormuz, where around 20% of total global oil production flows daily, could lead to crude oil prices hitting about $100 a barrel. Before we continue, a short break. If you are a small business, here is a useful announcement. Did you know that Google Maps, Google Search, and GPay, among others, can help you reach more customers and much faster? The core report invites you to hear top Google leaders tell you how to leverage new features from the Google tech stack. Join us at the Google India Small and Medium Business Summit at the Leela Ambience, Gurgaon on the 4th of October 2024. Do go to the link in the description and register now. And yes, it's free to join. And now, back to the show. Lifting of ban on India's rice exports could bring down prices. India has removed most of the export curbs it imposed on rice shipments in 2023 with immediate effect thanks to an above-average monsoon rain phenomenon that we've touched upon, which in turn has led to bumper crops. This will lead to prices coming down sharply and, of course, bringing cheer to non-resident Indians or NRIs who are paying much more for the specific India rice that they've always wanted and liked. India represents more than 40% of the world's rice exports, or rather represented 40% of the world's rice exports in 2022 at a record 22 million tons of a total of about 55 million tons. India's exports were bigger than the combined shipments of the world's next four biggest exporters, that's Thailand, Vietnam, Pakistan, and the United States, according to Reuters. The lower exports caused disruptions in the global market, even as buyers found new sellers in Thailand, Vietnam, and Pakistan. And NRIs were perhaps the most upset, as we said, and used to as they are with rice that comes from India and not just any rice. India exports broadly 3 or 4 kinds of rice. In a good year of some 18 million tons, parboiled rice is about 8 to 9 million tons, white rice is another 7 to 8 million tons, while broken rice is about 1 million tons. Basmati rice, whose exports were also curtailed, is around 4 million tons, which is distinct from that 18 million tons. I reached out to BV Krishna Rao, president of the Rice Exporters Association, and he is based in Kakinada in Andhra Pradesh. And I began by asking him how the curbs had first affected Indian exports before asking him for an outlook now.
As you are aware, the government has lifted both curbs which they have put it close to 12 to 14 months earlier. In terms of white rice, they have totally prohibited the export. Whereas on parboiled, they have raised highest ceiling of 20% as export duty, both of which were detrimental in exports. At that point of time, that this probably they are contributing to inflation in a large number. So having seen for 1 year the impact of this particular varieties on inflation has been calculated, and crop that is coming in the next 2-3 months, keeping the farmers' interests, I think the government has decided that both of these should go, maybe not in total entity entirely, but partially, at least it is a midway. So they have reduced the duty from 20% to 10%. Still, internationally, we are the cheapest origin for parboiled rice, and therefore we strongly welcome the move on the government. And we are there in the business, despite last year's hiccup of this 20% at one go. So this 10% reduction will always be helpful for the trade, and we'll be able to pass on this additional 10% to the Indian farmers also, as their produces will be coming to the market in the next 15-20 days. This is helpful for the farmers. And as far as white rice is concerned, they have put a MEP instead of duty, so that they are still cautious that at a higher MEP, only few variants will go out of India. So we respect their cautiousness. Probably we'll keep asking the government to reduce the MEP in times to come. But for a start, we are happy that the entire business of some of the people which have come to a standstill, they have revived their businesses in the next couple of weeks.
Right. And how is the crop been this year, or how is the crop looking this year? Because from all indications, it's looking like a very strong crop, isn't it?
Thanks to the monsoon, I think pretty much high, especially in the south. Monsoon more than the normal, filling up all the reservoirs for the next Rabi crop. So the farmers are buoyant that they will have a next. Generally, farmer makes more money in the Rabi crop because the duration of the crop is less. The yields for a farmer is more. So as far as Kharif is concerned, he will be able to make minimal margin only. Rabi, he will make maximum. So he's more buoyant about the Rabi crop also. And in the meantime, these two restrictions have been removed. and the space for the warehouses of FCA are also limited. So I think so farmers should get slightly over the MSP and take the advantage of the international market.
Right. Now, in the last year or so, obviously countries who have benefited are Thailand, Vietnam, Pakistan, Myanmar. So, do you foresee that buyers coming back to the market for Indian rice? That's one. And secondly, the last time I spoke to you, I think we were also talking about how NRIs were affected because they like rice from India. So, do you see that changing?
Yeah. As you mentioned, NRIs, I think this news of opening up really dropped their prices internationally because all the Sona Masuri, all the Indian preferred varieties, which were despite the ban, some way they were reaching US and all. We are not sure how it's reaching. So last night, Saturday night to now, there's almost a drop of close to $150, $200 in their prices. I think all the NRIs are very happy about the drop in prices because India has opened up. That's point number one. As far as the competing countries are concerned, as Pakistan, Vietnam, and Thailand, they have had a premium for the last 12 months. And they're all disappointed because this news of opening up happened at a time when their crop are still at the farm gate level. So the farmer, they thought if at all the news comes after a month's time, the produce would reach the Pakistani millers and the Vietnamese millers. But it has come at a time wherein the produce is still at the farm gates. So Pakistani farmers and all these countries, the farmer will be losing the premium which he was anticipating when he was planting the crop.
Right. And last question. So, we are now in October. How is the rest of the year looking like?
Well, last year we did close to what we were supposed to do. That was around 8 to 9 million ton. White rice 6 to 7 million ton, which we have lost to competing countries. There's high possibility that the entire volume will come back to India by end of this year. I think we are going and we should be able to touch our previous records, which stand at 18 million tons of non-basmati rice. So I think with slightly MEP is a disadvantage at this moment, probably, but Pakistani and all the prices are way above Indian prices. Demand should come back to India, sir.
Right, Mr. Rao. Thank you so much for joining me.
Yes, sir. Thank you very much.
140 years of coal power to end in the UK. Britain will become the first G7 country to end coal-fired power production on Monday with the closure of its last plant, Uniper's Ratcliffe-on-Soar in England's Midlands, says Reuters. This will end over 140 years of coal power in Britain, according to Reuters, which added that this follows Britain's 2015 plans to close coal plants within the next decade as part of wider measures to reach its climate targets. At that time, about 30% of the UK's electricity came from coal, but this had fallen to just over 1% last year. Now, this drop in coal power has helped cut Britain's greenhouse emissions, which has more than halved since 1990. Britain has a target to reach net zero emissions by 2050, and it also plans to decarbonize the electricity sector by 2030, which will, of course, require a rapid ramp up in renewable power such as wind and solar, said Reuters. Mumbai sees the fastest 100,000 property registrations. Mumbai City, which comes under the BMC, recorded about 105,000 property registrations in the first 9 months of 2024, according to real estate consulting firm Knight Frank. Property registrations were up about 12% year on year, while revenue grew about 6% year on year during this period. The 100,000 property registration mark was achieved in 2023, but that was in October or a month later. In September, residential units constituted 80% of total registrations, underscoring strong housing demand. On the other hand, September 2024 saw a 14% year-on-year decline, but Knight Frank says the decline in home registrations can be primarily attributed to the inauspicious days of Shraddh, which constituted 12 days of a month in 2024, when traditionally individuals refrain from making significant purchases or engaging in high-value transactions. In 2023, Shraddh was observed from 29 September to 14th October, so we will know in a month whether and how much of that dip in sales is linked to seasonal reasons or otherwise. So stay tuned for that. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.